So let me tell you a little bit about blockchain. Now, this is really hard because sitting in the front row and the first few rows are all the great experts who know far more about blockchain technically than I do. And so I'm sure every time I see one of them wince when I tell you something, please accept that it's because I'm trying to make it easy to understand and generic. And I guess if we look before blockchain, let's just understand a little bit about history to understand the impact of this innovation, this profound innovation that's likely to change the way that we transact value. But long before we start to think about virtual currencies and DLT, we really need to look back at what happened with information. And in the beginning, you had printing and you had broadcasting and eventually the internet. And you know, the development of the spread of knowledge, I suppose, was largely facilitated by the printing press. And the printing press is quite a new invention, but suddenly you had this way of putting into production documents that previously had to be hand copied. In fact, every single copy was different, and indeed every copy of a document might not have been quite the same as the original. And suddenly you had this ability to produce printed matter and circulate it widely as a consequence. And that acted as an immense agent of change. It was part of, if you like, the democratization, or the first, or certainly an early step in the democratization of knowledge. It helped bring about the scientific revolution. The fact that scientists could communicate, could get their ideas down on paper and communicate those ideas widely, gave, if you like, birth to the opportunity to other academics, other scientists, other inventors to critique. I suppose the whole nature of peer-to-peer review really is built on the back of the printing press. And it had all sorts of interesting side effects, one of which was the huge rise in literacy, adult literacy, initially in Europe, but of course that spread throughout the world. The fact that until the printing press, knowledge was largely in the hands of the princes and the papacy. Suddenly, knowledge could be spread and disseminated in a way that meant that to understand it, you needed to learn to read it. And so suddenly you had the reason for literacy. And if you like, a side effect of that was the growth of cities, or certainly the accelerated growth of cities, and indeed commerce as a consequence. But it wasn't all plain sailing. It didn't happen just out of the blue without any criticism. Far from it. You know, one of the reasons that it was severely criticized, usually by those, of course, who were in power, who controlled information previously, was that it would allow the dissemination of information which might not be correct, it might not be true. So we have a little history there of how something that seems quite a small new invention, in fact, it wasn't really that much of a new invention because it didn't happen in isolation. It happened as a consequence of all sorts of different things. Without woodblock printing from China, without the production of paper, without ink, the printing press would have been fairly useless. But suddenly all these things came together and you had the industrial production of publications. And it's had a profound effect. The fact that you're sitting here all with your printed program, the fact even that you responded to the invitation has something to do with the printing press. But of course, we moved from that. We moved on in the 90s, really, to this internet thing. Do you remember, those of you who are old enough, folks who used to say, well, this interweb thingy, it'll never really catch on? So history is littered, ancient history perhaps not, but more recent history in the last hundreds of years, or even in the last tens of years, has moved on in big steps, incremental steps, as a result of fairly small inventions, creations. Can we imagine a world today without the internet? Could we transact anything? Could we buy anything? Could we read our health records? Could government function? Could this EUIPO even maintain its own records or remember who each of us are who are attending today without the internet? So let's fast forward, 2008, and we've got this new thing called Bitcoin. Now, there have been some attempts to create digital cash before, but never had we seen something that actually worked. They came and they went, and suddenly there's this new invention, if you like, a bit of a printing press moment, and suddenly some ideas, not many of which were totally novel, but made up of computer science from the 70s, the 80s, and the 90s, were brought together and fashioned in a particular way that suddenly we had this new technology. Now, this is the bit where the folks in the front few rows will really enjoy, but the folks in the back probably will need to read this several times over. But if you really want to know what Bitcoin is, well, it's very simple. It's based on an open access participatory model of market-based economic competition through risk and reward strategies based on game theoretical outcomes that ensure collaborative participation by multiple participants without anybody having the ability to cheat, due to a system of emergent consensus based on mathematical rules and strong cryptography. Got it? Anybody want me to go over it again? So that's what Bitcoin is. Let me try and put it into some simpler terms. The Financial Action Task Force is the multinational, well, it's not really a governmental body, but it's a multinational body that develops the guidelines that really form the basis of anti-money laundering measures that are adopted across the world. And I guess it's a kind of standard setter. That would probably be a way to think about it. Well, it looked at this new stuff. Originally Bitcoin, which I'll explain in a moment, is itself something that belongs to a family now of technology known as cryptocurrency. And it thought, well, we'd better have some definitions about what this stuff is so that we can start to understand how to deal with it. And so it identified some properties of something it terms virtual currency. The first three, medium of exchange, unit of account, and store of value, are in common with every other kind of currency, fiat currency, the real money that we use in our everyday lives. Medium of exchange is really a way of saying that it's used in exchange for goods and services. You either tender it to obtain goods or services, or you receive it in exchange for goods or services. It's a unit of account because you can measure it. You know that €1.50 will buy you a cup of coffee. It's got some sense, and you know that if you go to Starbucks and it costs you $1.90, it's a little bit expensive, and if you found somewhere that just charges you €1, that's a pretty good deal. So it's a measure, and you can apply the same thing to cryptocurrencies, virtual currencies. And a store of value, because you can exchange it for goods or services and hang on to it and keep it for a while, and it'll still, broadly speaking, maintain its value. Now, immediately, there are those of you who've heard about Bitcoin and how since 2008 it went from being worth virtually nothing to around $6,000 today. Now, that's probably not representative of something that's a good store of value. Well, it is if it's on the up, but of course it swings about quite a lot, and the volatility doesn't really encourage its use yet as a store of value. But nevertheless, it has the capability of the properties that are needed. But then it has some other, this virtual currency stuff has some other characteristics, namely that it's not legal tender anywhere, it's not issued or guaranteed by any jurisdiction, and surprisingly, it functions only by, if you like, the agreement of its community of users. Now, the Financial Action Task Force was, I suppose its view about this new stuff as being currency was endorsed to a certain extent by the European Court of Justice, who were asked to decide a VAT case a year or so ago, and came to the conclusion indirectly, it wasn't being asked what is virtual currency, but it needed to consider what it was in order to determine the particular VAT questions. And it decided that it was used like money. So unlike some other parts of the world, here in Europe, I think we can more or less say that there's endorsement for it being like money, like currency. So we've got some definitions. There's this virtual currency stuff. There's this other stuff called cryptocurrency, which is, if you like, a subdivision of virtual currency. Virtual currency can come in a wider array of flavors. And Bitcoin was the first cryptocurrency. There are now well over 100 cryptocurrencies and well over 1,000 digital assets that are based on the same basic principles. I'll skip that one. So what's the big deal? Well, cryptocurrency allows two people to exchange value with one another without the need for an intermediary, and they're able to do that completely digitally. What that means is that it's both a currency, just like pounds, euros, dollars, yen, and also a payment system like banks and Western Union and PayPal. It performs both the function of a currency and the payment system all rolled into one, and that's never been done before. So where are we now with virtual currencies? Virtual currencies have been around, as I mentioned, since 2008. That's when the Bitcoin white paper was published. The first transaction in Bitcoin took place in January 2009. And as at yesterday, its market value, when measured at free market exchange rates with the dollar, amount to about $94 billion US. That's from zero in 2008. Bitcoin, the first cryptocurrency, today represents about 56% of all cryptocurrencies. And it's by far and away the largest in terms of its network capacity, and it's the largest in terms of value, and it overshadows all of the rest. The most notable of which, for reasons that we'll come to in a moment, is Ethereum, the second largest virtual currency, which today is worth around $29 billion US and accounts for 17% of the value of all cryptocurrencies. And the third one, Ripple, which is really oversimplistic, but it's a kind of SWIFT, an interbank messaging, payment messaging and settlement system, which is valued at about $8 billion US. But its use today, virtual currency use today, is still largely for speculative investment purposes. It has yet to take hold as something that people, as a commonplace thing, used as a medium of exchange. In other words, used to buy and sell goods and services. And therefore, I guess we'd say we're very much at its infancy, at its adoption infancy. But there's a lot of words here. We've talked already about virtual currency, cryptocurrency, and Bitcoin. You've got this stuff that's called digital currency. Now, the Financial Action Task Force says digital currency is an overarching term for virtual currencies and e-money, things like PayPal and so on that have been around for a long time. And then we've got other words that come in like blockchain, distributed ledger technology, or DLT, and smart contracts. And there are a few more that folks in the front rows will be more than happy to talk to you about over coffee. Well, let's understand the next word on that list, which is blockchain, because that's really what we're here to talk about today. And what blockchain is the technology that underpins Bitcoin. It was think of it as the mechanism that enabled Bitcoin to deliver all those capabilities that I talked about early on, medium of exchange, unit of account, and so on and so forth. And I guess if you think of it in simple terms, it's really just an asset database that's shared across a network that could be made up of multiple sites, multiple geographies, multiple institutions. The more nodes that are connected to that network, the better, the safer and more secure it is. And essentially, every participant in that network has an identical copy of that database and has it updated simultaneously. At its heart, you'll pick up on this in a moment, but it's not called cryptocurrency for nothing. At its heart, it uses cryptography, the same kind of cryptography that banks and governments use. Cryptography really supports the security of the system and the accuracy of the information that's contained in the database. And what happens is that in the case of Bitcoin, it varies from one cryptocurrency to another, but broadly speaking, every 10 minutes or so, the last 10 minutes worth of transactions, or any that weren't previously recorded, are grouped together, and the participants in the network have a little competition amongst them, each other, to try and grab as many of the transactions that are floating around the system as they can possibly get hold of, perform some calculations, and I guess have a kind of computer game to try and win the right, if you like, to put a new block on the blockchain. Think of this new block as a file, or as we talk about distributed ledger technology, think of it in ledger terms. Think of it as a page in the ledger, a loose leaf ledger that on which is recorded lots of transactions, and that is inserted into the top, at the top of the ledger, the most current page in the book. And think of that binding system as some mechanism by which you can't, after you've inserted it, remove it in any way. So that all the information that's on that last page and all the other pages in the ledger are immutably set in stone. They can't be tampered with, they can't be changed. And once a new page is added to the ledger, then the game starts all over again. And 10 minutes later, the winner of the little competition that's grabbed hold of all these floating transactions in the previous 10 minutes gets to put yet another page, which in turn cements all of the information that went before it. What you have as a result of this is some digital, immutable record of truth that is held everywhere and yet nowhere in particular. And some people characterize this mechanism where you don't need a bookkeeper anymore. They characterize this as delivering trust in what is otherwise a trustless world. What I mean by that is not an untrustworthy world. It's just that I know that I can trust one or two of you here. I know I can trust Alexandra and Paul. I think I can trust a lawyer. But some of the rest of you I've not met before. And so, you know, maybe I can trust you or maybe I can't trust you. I have no way of knowing. And that lack of knowledge of who I can trust, I think you can think of as a trustless world, one where we don't know who we can trust. And this mechanism provides that means of providing trust. In fact, so much so that The Economist, the illustrious periodical, weekly periodical, 2 years ago, I think it was the 31st of October edition 2 years ago, devoted an issue to this blockchain stuff, and its cover talks about the trust machine. You can still read it online if you want to, and it's still very relevant today. Here's a quote from it. In there somewhere it says, "A world with record keeping mathematically immune to manipulation would have many benefits. By offering a way of setting the past and present in cryptographic stone, blockchains could make the future a very different place." Now, blockchains aren't a one-size-fits-all. That's why there are so many different cryptocurrencies and crypto assets. And they broadly come in different main categories. And again, I'm being general to explain this. I'm sure over the next 2 days we'll have an opportunity to explore in more depth some of the detail around this. But think of blockchains, these databases, as either being public, where anybody can choose to participate, or private, where somehow the group of participants is controlled, is limited. And think further that some of these blockchains are databases which are permissionless. Anybody can choose to join of his own choice and will have to be accepted into that network, or permissioned, where only certain participants qualify to participate. So on to another term on that word soup list, smart contracts. Now these are a spin-off from one of the, well, if we think about the progression, we started with Bitcoin, and the next big one that came along was Ethereum. And Ethereum added some capabilities that meant that you could add more than just data to this database that's shared everywhere, and added some intelligence to it. So think of smart contracts as being blockchains that contain both data and self-executing code. Self-executing code means little programs that run themselves in this distributed network without the intervention of anyone having to start them or stop them. And they can react to things that are happening either on the blockchain, information that's occurring, actions that are taking place, changes of state that happen in the database, or they can happen as a result of, they can be triggered by external events. So we've gone from this very simple idea of digital cash to stuff that actually lives in a world of its own, can create itself, change and transact all on its own. Here's a quote from Adrian Collier in a recent paper last year. He wrote that decentralized smart contracts enable fair exchange between mutually distrustful parties based on contract rules, removing the need for physical rendezvous, third-party intermediaries, and reputation systems. What can you use this technology for? Well, at random, out of at least hundreds, if not thousands of possible use cases, here are a few. Some of the most talked about. The obvious one around peer-to-peer payments. The idea of having digital cash that's a currency and a payment system is obviously ideal for transacting peer-to-peer. You don't need to use a bank or another institution to move funds or value. And payments leads to lending, peer-to-peer lending. Currency exchange, remittance between, usually between the developed world and the developing world. Proof of authorship and ownership. You've got an immutable record. Once recorded there, it's effectively notarized and cannot be tampered with in any way. Insurance presents a whole range of use cases. Identity. Forget the passport photocopy and the copies of utility bills and the other high-tech ways we have of proving who we are. Think now of something that's entirely digital and immutable, something which you yourself can choose to share with those that you want to prove your identity to. Data storage, decentralized data storage. What a wonderful opportunity. We've all got computers with huge amounts of spare capacity and resource, and we could sell little pieces of our spare data and be rewarded for it in cryptocurrency. Securities trading, stocks and shares and other forms of securities, indeed the clearing and settlement that is so complicated and burdensome can all take place on blockchains. And these are just a few. So why is blockchain bigger than just Bitcoin? That original 2008 idea, that white paper published anonymously on the internet? Well, don't just take what Siân Jones has to say. You've got some leading global institutions that believe that this is a predominantly disruptive and transformational technology. There's a wonderful report published nearly 2 years ago, January, I think it was, 2016, by the UK government chief scientist, in which he explored all the different use cases and the potential, not just in the financial space and in the non-financial private sector, but also for governments and the public sector. The Bank of England has done a tremendous amount of research on the possible use of this technology in what are going to be known as central bank issued digital currencies. They profoundly believe that the real-time gross settlement system, the thing that allows banks, commercial banks, to transact with each other, in the UK at least, and probably elsewhere, will be based upon blockchain technology, distributed ledger technology. The IMF, just a month or so ago, again, Christine Lagarde, the managing director of the IMF, had some really striking comments around about the use of this technology and how transformational it will be. The World Economic Forum have produced several papers on this, and indeed so has the European Parliament, and particularly a report that the European Parliament put out in May last year, and which is going to be supplemented by a new report that's just being started, work on which is just being started now specifically on the underlying technology. The UK government chief scientist, Sir Mark Walport, he said that distributed ledger technologies have the potential to help governments to collect taxes, deliver benefits, issue passports, record land registries, assure the supply chain of goods, and generally ensure the integrity of government records and services. Now, we trust government in the developed world. Think how profound a statement that is in the developing world where corruption is still rife. And how might this technology be used then in public administration? Well, again, just a few use cases. Property title registration. So this would bring both a registration efficiency, it would prevent fraud, and it would provide much needed transparency. Driver and vehicle licensing. The registration of companies, the delivery of social security benefit payments, the provision of digital identity, and even voting. And since this subject is going to be picked up later on today, just within the IP world, think about supply chain, think about anti-counterfeiting, track and trace, customs enforcement as just a few use cases that I know are going to be explored over the next, in the next sessions and over the next day and 2 days. Now, Sir Mark Walport recommended a number of things. He said, firstly, governments should use blockchain technology. He said that governments should invest in research, should create a regulatory framework, and help set standards to ensure security and privacy, and broadly speaking, to build trust and interoperability. And this has started to happen. Blockchain today is, I suppose, big. In investment terms, venture capital funding in the last 4 years amounts to over $2 billion US. Token sales, which are a form of crowdfunding using the tokens that can be created using the technology, effectively using those tokens to raise funds instead of raising equity, just in this year alone has raised over $3 billion US. So you're talking now about sums of money, $5 billion US in investment alone in a technology and the businesses that are working on that technology. We've seen a wide range of regulatory responses. These are they vary from China, which recently put a ban on virtual currency exchange activity. It put a ban on the use of tokens as a means of raising finance. But that's after a period where China had accounted at one point for over 80% of all the trades that were being undertaken in cryptocurrencies. The other end of the scale, you've got jurisdictions that have applied new regulation. New York State, for example, was one of the first out of the starting block with its so-called bit license regulation, but it was very burdensome, very cumbersome, very expensive, very broad in scope and yet narrow in where it targeted, and it achieved very little. Is anybody here from New York? It achieved very little because only a very few established players could actually afford to comply and cope with its burdensome regime, and consequently the number of bit licenses that have been issued, I think, can be counted on 2 hands. You've got other jurisdictions. I will immediately claim some interest in this, but I've been working with the Gibraltar government for the last year in developing a regulatory framework for DLT businesses. It became law 2 weeks ago. And this is designed both to encourage business to operate and also to do so safely for consumers and safely for the jurisdiction, so that there's no reputational damage as a result of bad business being centered in the jurisdiction, and very positive. So much so that dozens of companies from around the world have decided to either move their existing businesses, including some of DLT's largest players, and move to set up in Gibraltar, a European destination with a population of 32,000 people, and now a blockchain hub of the world. And most other jurisdictions that have done little or nothing and just sitting on the fence waiting to see what happens because it doesn't quite understand what kind of regulatory response to apply. And you've got all shades between those. In parallel with that, just as, forgive me, Paul, I'll try not to poke your eye out next time. Just as Sir Mark Walport had recommended, not only is there a regulatory response, but there's also a standards response. And I'm pleased to say a year ago, the International Standards Organization, International Organization for Standardization, and yes, it's ISO, I still don't get it either, but ISO created a technical committee to look at blockchain and distributed ledger technology. And I'm pleased to say there are folks here in the audience today and who you'll be hearing from, who I'm very proud to serve with as a member on that committee. There are several open source projects. I mean, a lot of this technology is open source, but significant open source projects such as the Hyperledger project, which started off largely as a bit of code that had been created by IBM and was donated to the Linux Foundation, the Linux of the alternative open source operating system, Linux, and donated to them to run as a project, as a foundation, and to which many other contributors have now added code, and where there is now some real product starting to take shape. And consortia of large global organizations, one alone, R3, is constituted of about 70 or 80 of the world's largest banks working together on developing the technology. There have been governmental responses from many jurisdictions. I don't want to pick on just any particular ones, but I have talked about the European Union a little bit. There's a parliamentary report. Parliament has examined virtual currencies. It is now examining the broader digital distributed ledger technology, and it's part of its digital agenda. It's also initiated a European and EU blockchain observatory and forum, which it will be announcing quite soon. The UK was one of the first nation states to blow a trumpet and say we're going to be big in this and we're going to support it, and then has done absolutely nothing about it. The USA is so fragmented. Correct me if I'm wrong, Mark, but you're talking about 50-odd states plus the federal government and many different institutions, and frankly doesn't quite know what it wants to do as a nation, and so has a variety of different responses internally, ranging from that very convoluted bit license on the one hand to a Wild West in some states. China, which is really the hotbed of the speculation that's been going on, but which is, as a jurisdiction, decided to put the brakes on for the time being. Russia, which was against it and is now throwing billions into making it central to its future, and has announced that it'll have regulation in the space in a year's time. Japan, which suffered one of the first significant losses through the so-called Mt. Gox. Well, Mt. Gox was an exchange that lost $800 million worth of Bitcoin, just disappeared. And that meant that it had to focus on what it should do, and as now has a regulatory regime for virtual currency exchanges and is regulating virtual currency exchanges, and Gibraltar, which I mentioned a moment ago. And that standards work. So the ISO technical committee is currently developing definitions. You know, how important is it that if we're going to understand a topic, we should have a common vocabulary and understand what it is that we're talking about? Yes, we've got some definitions from FATF on virtual currencies, but blockchain is a much bigger subject than that, as I've explained, and yet we have no agreed language that we can use universally. So the first piece of work that's being undertaken. Standards, I should explain for those who know nothing about standards development, is a bit like the EU, like Brussels trying to make new law. It takes almost as long. So don't expect something to be published next week or indeed necessarily next year, but there will be a vocabulary that we'll be able to use universally around DLT. And there are other work streams around reference architecture. You know, what is a blockchain? How do you make it up? Around security and privacy, around identity, those clever smart contracts, trying to see in what way standardization can help the development and use of smart contracts. And there's even a work stream around use cases. Now, there won't be a standard about use cases, but it's been set up to inform the other work streams about how this technology is used. And we're also considering on the committee setting up work streams around governance and around interoperability. I guess I have time for one question.
Sheila Castles, the Audiovisual Anti-Piracy Alliance, otherwise known as APA. I mean, I'm encouraged in a way to hear what you say about the standards work and the regulatory work and so on that's going on. But I just wonder if once we've got all that in place, is blockchain actually different to anything else that we've seen before?
Yes.
That's a short question.
The question was meant to be short, but the answer is it should be a bit of an explanation, please.
Forgive me. This is a profound new technology which enables folks to interact in ways that could not be achieved before without someone setting up some central entity, some trusted, so-called trusted third party, some middleman to run it. And so without wanting to spoil the fun of the next 2 days, where exactly how it's different and why it's different and what it can achieve, certainly within the IP context, I'll leave to those other sessions. But I think you do raise a very serious point. Blockchains aren't the cure for cancer or the answer to world poverty. Blockchains are good at some things, and they do that particularly well. One should not be wooed into the idea that somehow blockchains are for everything. They will be good at some things, and particularly good at some things. They will make little or no difference, and indeed could prove to be cumbersome in other scenarios. Stick around for the next day and a half.